Hi, I'm Seth Freudberg. I'm the Director of Options Trading here at SMBU in Manhattan. I'm also the head trader of SMB Capital's Options Trading Desk. So today I'd like to talk about the role of technical analysis in market neutral options trading. Market neutral options trading, as we discussed before, is different from pretty much any other form of trading, day trading, swing trading, futures trading, currency trading, whatever. And the main reason is because we're trading in ranges and we're actually looking for non-movement in the market, whereas most other forms of trading prosper when there's movement. But there are some other complications that make market neutral options trading a little trickier. And one of them is that if you look at day trading, for example, there is a very clear connection between price movement and the value of your position. If you're long a position and that position goes down $1, you will lose $1 for every share that you own, and vice versa. That's a very clear, direct, and straightforward relationship. Whereas in options trading, if you have a 1-point down move, you don't necessarily lose $1. You may gain money. Lots of factors can contribute to whether a position gains or loses value. It is not just price, although price is one of the components. There are other aspects, and those combined are called the Greeks. And those include the passage of time, time decay, and they also include options volatility, which is measured by Vega. So it's not a simple relationship between the value of an options trader's position and the value of the underlying that you're trading. It's a little more complicated than that, and that's why you need to understand the Greeks. Now, I've been mentoring students for 8 years, and the interesting thing is that traders who have strong directional or technical analysis skills as day traders or swing traders, perhaps excellent traders, oftentimes are very difficult to mentor for market neutral options trading. And that is because they have such strong technical analysis skills that they know when there's a very high probability of the market going up or the market going down. They have a good feel for that. But I just said probability. I didn't say certainty. And therefore, while it's probable that one thing or another may happen, there is no certainty of it. It's just a matter of probabilities. Well, in day trading, you can live with that, because if what you expected to happen is wrong, you can easily measure the implications of that and hit out of your position if you need to. But in market neutral options trading, if you use technical analysis and ignore your risk management requirements of the trade, you can get into really big trouble quickly if you're wrong on technical analysis, yet you have not followed your risk management guidelines. So let me give you an example of this. Let's say that you entered into a iron condor trade, what's called a low probability iron condor, where the short strikes of the call and the put are both 20 deltas. All right, let's suppose that you entered into that trade and that your risk management required you to roll the trade, roll the side that's in trouble if the delta of the short strikes gets to 40. Let's suppose that you've entered into that trade and those are your back-tested, time-tested risk management rules. All right? Now, in that case, then let's see what happens if you take your technical analysis skills and overlay that to the trade. In this example, we are short the 2405 calls, and we are also short the 2280 puts. So in this technique, if the market rallies, there is a good chance that you will hit the adjustment point on the upside of the trade, and you'll have to roll the call side up. Well, let's take a look at a chart now. I think most people with technical analysis skills would say 2400 is a very important level on the SPX. And I think that that is a fair statement. I think most people would agree that if the SPX gets through 2400 with some energy, that is technically significant, okay? Well, but it just so happens that right around 2400, this trade gets to negative 40 deltas. So if you are a trader that believes more in your technical analysis skills than your risk management skills, something very bad could happen if you were wrong. If your feeling was the market is going to bounce off of the resistance of 2400 and sell off, so I'm going to wait. I'm going to let the delta of the call strike get to, of the short call get to 45 or 50. If you were to do that, I want you to see what would happen. Right now, this trade is down about 1,200 bucks. If you went and ignored your risk management rules and allowed the market to run to 2,400, assuming that it is going to bounce off that level, when you may think it's probable, but you don't know as a certainty that's going to happen, your loss triples, nearly triples. Your current loss is at 9%. And if you were to roll, then your trade would be down 9% when you establish the new position with the call strikes farther out from the money. But if you allowed it to get to 2,400, now your trade is down not 9%, but 26%, and you may well be knocked out of the trade. In any event, you're in a very dangerous position that you should never have allowed yourself to get into. So let's compare now the implications of a move like that. If you were a day trader, and let's say you're long in this example, SPY, and you bought the SPY at 240. Let's suppose it got to 240 and you bought it. And then the market pulled back to 239. If you do the math, that's a 0.5% drop in the value of your position in the SPY. But if you have a 1% move in the example I just gave you, and while that's an example of an up move, the same principle applies. With a 1% up move in this example, your trade went from a 9% loss to a 26% loss. In other words, there was a 17% loss against your capital in the options trade, but only a 0.5% in the day trade. So you can see clearly, and I could give you 1,000 examples of this, that the day trading implications about being wrong in technical analysis and the options trading implications about being wrong are two very different things. And because options trading can be dangerous, you need to follow your rules very carefully, even if your technical analysis tells you that it will bounce, and that the market will sell off once hitting that important resistance level. You just can't take the chance, because if you're wrong, the ramifications are really bad. So you may be asking the question, does technical analysis have a place in market neutral options trading? And I say absolutely it does. You, for example, can set a trade up consistent with your technical analysis of the market. So if you think the market's about to sell off, then you might sell that iron condor where the call strikes are much closer to the market. But once having leaned your trade in your technical direction, if you are wrong, you must follow your risk management guidelines, or you will not live to trade another day. So therefore, if you have to choose between risk management and technical analysis, you must choose risk management every single time. Might you regret it sometimes? Absolutely, particularly if you have strong technical analysis skills. But this is not day trading, and this is not swing trading. The implications of being wrong are much more serious in options trading than in day trading, and therefore you must allow your risk management skills to trump your technical analysis of the market, because if you're wrong, it can be a problem, and you may not live to trade another day. Thanks so much, and we'll see you next week.